Today, I want to talk to you about how to get retirement income from preferred shares. And at the end of the video, I'll show you the preferred shares, some of the preferred shares that I own. Now, this video is educational in nature. This is not a recommendation of particular securities, so please do your own research or talk to your financial advisor. Okay, so preferred shares, let me explain how they come about. So when companies need to raise money, they have a few choices, right? Companies need to raise money. They need to build a new plant or do something, so it's not like they got the cash sitting around in the bank, so they raise money. Now, there's a few different ways for companies to raise money. Number one, they sell common stock. So if you've probably bought shares of stock in a company and you become a part owner. Now, companies don't like to sell more shares of stock. Why? Because if you and the other owners, let's say, own 100% of the company, and let's just say it's 100 shares, if the company issues another 100 shares, you don't own 100% of the company anymore. You own only 50% of the shares. So that dilutes your interest, and the existing shareholders do not like it when a company issues more shares unless they have some outstanding opportunity. So companies try not to issue more shares and dilute the current shareholders. Plus, the dividends they pay, if they pay dividends on their shares, they're not deductible for tax purposes. So those are the reasons companies shy away from issuing common stock. Now, they have another option. They can sell bonds. They can borrow money from people. So when they sell bonds, they issue the bonds to you and they promise a fixed interest rate over a period of time. Now, the good news for the company about that is they get a deduction for the interest payments, so it reduces their income taxes. But there's an offset to that, which is when Wall Street looks at a company, Wall Street looks at how much debt they have. So if they've issued bonds, they have more debt, and that sometimes can be less attractive. So companies don't want to issue too much debt. They want to issue a healthy amount of debt. Now, there's something it can do that's in between. That's what preferred shares are. So the preferred shares are not counted as debt, even though they pay a fixed dividend, and it's a dividend rather than interest. So they can't deduct the dividend, but they get the benefit that the preferred shares do not show up as debt on their balance sheet. So it helps them maintain this healthy ratio that Wall Street's looking for. And because it's not common stock, it doesn't dilute the current shareholders. The people who own the common stock still own the same number of shares. They still own 100% of the company, and they suffer no dilution when a company issues preferred shares. Okay, now what I want to do is take a look at some different types of preferred shares that exist. So we'll divide these into four categories. I'll call the first category plain vanilla. I'll call the next category floating rate. Next category convertible, and the last category we'll talk about cumulative. Okay, so I want to show you examples of these four different types of preferred shares. Now, if you've never invested in preferred shares before, people who are new to something, or if it's something you haven't heard of before, you always think it's more risky than it is. Just like somebody who jumps out of an airplane 500 times doesn't think of it as risky as the person who's never jumped out of an airplane. But when it comes to preferred shares, if you're super conservative, you might want to invest in bank preferred shares. For example, Wells Fargo, well-known bank. These are all the different, each one of these rows is a different type of preferred share that they've issued. And as you can see, the list goes on and on and on. And generally, these bank preferred shares, right now, while we're recording this in November of 2022, the yield on these is about 6%, okay? So if you think Wells Fargo or Bank of America or Chase Bank is pretty safe and the government's never going to let them go under, and you like the idea of earning 6%, these preferred shares may be attractive to you, okay? So let's take a look. And by the way, if you don't like Wells Fargo, here's Chase Bank. Chase also has a whole bunch of these preferreds. Each row is a different preferred share. And as you can see, the yields are somewhere in that 6% range. Okay. So let me first talk about a plain vanilla preferred. Okay. So here's a Bank of America preferred share. And when preferred shares are issued, you'll notice the current value of this on trading on the New York Stock Exchange is a little over $24. When preferred shares are first issued, almost always they're issued for $25 a share, and they pay a fixed dividend for the life of the preferred share. Okay. Now, once these preferred shares are issued, people who buy them are free to sell them, just like a common stock on the New York Stock Exchange, for example. So these preferred shares will change every day. They'll change hands all the time. Now, what happens if something pays a fixed rate of income? When interest rates rise, that security becomes less attractive, right? Because think about something. If something pays you 6% when you can only get 2% on treasury bills, that's a big advantage. But if something still pays 6% and you can get 5% on treasury bills, it's not as attractive. So what happens to preferred shares when interest rates rise, as you can see here in this chart, the value has gone down. So these preferred shares were trading about $26 a share back in January. They're now trading a little over $24 a share 11 months later. Okay. Now, that's not necessarily a terrible thing, because my advice to you is if you ever buy preferred shares, don't trade them. Just hold on to them. You bought them for the income, so just who cares if it goes up or down a couple dollars a share? Just sit there and collect the income. So if somebody buys these preferred shares now, you could call your broker or go online, buy these right now at $24.26 a share. You're going to get a dividend rate right here of $1.47 a year, okay, which comes out to a yield of 6.05%. Now, most preferred shares are callable. So there's going to be a point in time, this one I think comes up July of next year, when Bank of America has the option to pay these off or redeem them. When companies redeem their preferred shares, they're redeemed at a specified price. It's specified in advance. Everybody knows what it is. So these shares are redeemable at their face value, $25. So if Bank of America does decide to redeem these shares that you bought for $24.26, they have to give you $25. Otherwise, they just have to keep paying you your $1.47 a year, which is your 6%. So that's kind of a plain vanilla preferred share and how they work. Let's take a look at some that are just a little different. Now remember I said most preferred shares are issued for $25 a share most of the time. These shares Bank of America issued, Bank of America 7.5% convertible. They issued these originally years ago for $1,000 a share. They're now trading for more, $1,200 a share. Now, what's the convertible mean? Convertible is when company says we're issuing these preferred shares. We're going to pay a fixed dividend, which in this case is $72.50 a year, which comes out to a yield of 5.95% if you bought these now at the current market price. Okay, but Bank of America says we'll throw in another kicker. If you want, you can convert these preferred shares into 20 shares of our common stock. Now, different preferred shares are convertible into different amounts of common stock. This particular issue, these Bank of America Preferred L, okay, they're convertible. Each is convertible into 20 shares of their common stock. Now, is that a good deal? Well, not right now, because Bank of America common stock is about $37. So what's 20 shares worth? About $750. So right now, you'd be crazy to trade something worth $1,200 for 20 shares of stock only worth $750. But people assign a value to this convertible feature, because what if Bank of America shares triple in value over the next 5 years? Then you'll be this value will continue to increase, because at any time, this can be converted into 20 shares of their common stock. So this is why people might take a little less interest. So other preferred shares, maybe they're yielding 6.5, but somebody would say, you know what? I'll be satisfied with 5.9, and I'm able to convert these shares in the future to something that may be worth a lot more value. So that's what convertible means, okay? Now, let's take a look at one other version of preferred shares, floating rate. So in floating rate preferred shares, rather than getting a fixed dividend, the dividend is tied to something else. So here, for example, in these Bank of America, they're called Series 1. I call them Preferred G because that's the symbol, Bank of America Preferred G. In this case, Bank of America issued these at $25 a share, and they were first issued at a set dividend for the first few years, but then at a certain point, the contract said Bank of America would then adjust the dividend to float. And what does it float? It says floating rate per annum equal to 3-month US dollar LIBOR plus 3/4. Well, so what that means is that right now, the 3-month LIBOR is 4.69, add 3/4, so it pays about 5.5%. Now, I'm not a giant fan of these floating rate preferreds because they're only attractive if the rates continue to go up, because then you get a bigger and bigger payment each year. But me personally, I'd actually rather buy a preferred that pays me 8 or 9% as a fixed rate and just sit there and collect it and not worry about if rates are going up and down, because I'll just get the same dividend every year. So I'm not a big fan of these floating rate preferreds. You may like the idea. They don't drive me crazy. Now, let me show you a few preferred shares that I own. And again, look, these are not recommendations I'm making. These are not things that I'm telling you you should buy. These are examples, and this is an educational video. All right, so here's a company called Crestwood Equity Partners. Now, Crestwood is a business. They're what's called a midstream oil and gas company, which means they don't drill for oil and gas, and they don't sell oil and gas. They are the intermediary, the middleman who transports the oil and gas. So when some company brings the oil and gas out of the ground and they've got to ship it 1,000 miles, Crestwood has the pipelines, and they charge per barrel or per 1,000 cubic feet of gas to transport those fuels. And Crestwood really doesn't care if the price of oil goes up or down, or the price of natural gas goes up or down, because they just get paid for every dollar or every 1,000 cubic feet. So it's a pretty stable business because the level of the amount transported from month to month doesn't really vary a lot. So it's considered a pretty great business, similar to a utility in that the income tends to be stable. Okay, now, these preferred shares, so they pay a fixed dividend rate, which is 9.25% based on the original price when they were issued. These were not issued at $25. This was a weird situation. I think they were issued originally at, let's see, I don't know, it was about $9 per share or something like that. They pay a fixed rate of 84 cents per share per year. Now, most preferred dividends, they actually break it up into 4 payments a year. So this pays 84 cents. So if you bought these for, right today at $9.12, you get 84 cents a year, which would give you a yield of about 9.5%, something like that. Now, I happened to buy these back, it was right about here, right after the COVID thing hit, and these things got really depressed. And I looked at this and I said, I don't think they're going to move any less oil and gas, or so looks like a pretty good bet to me. So look, I was lucky. I bought these when they were about $5.50 a share. So now I'm getting 84 cents a year on a $5.50 investment. I don't know, it's 15% a year, something like that. So clearly, if you can buy these preferred shares at the right time, you can lock in a really, really attractive dividend. So here's another example. I own MFA Preferred B. Let's just go to the detail page. Now, remember I said what's going to happen is preferred shares are going to decline in value. You can see the chart when interest rates are rising. Now, I'm not really worried about that. Why? Because I don't trade these. I buy them and I sit there and I collect the dividends. So right now, somebody could buy these shares. They were issued at $25 a share. Somebody can buy them for $19.65, and you'll get $1.87 a year, which comes out to a yield of 9.35%. So pretty attractive yield. MFA, by the way, is in the business of loaning money on mortgages secured by people's homes. So you might want to look, if you invest in a company like this, you'd say, well, how did they do during a terrible time like 2008 or 2009? And the case was, well, they didn't go bankrupt and they continued it and they weathered the storm. And these preferred shares have been clicking along the whole time, paying their income. So it's been a pretty conservative investment in terms of what it actually has done. Now, none of these are guaranteed. Every common stock, preferred stock, bond, they all have some risk. So if you're worried about risk, then just go buy treasury bills or put your money in the bank. But if you're interested in things that are sensible, conservative, where you're taking some minimal amounts of risk that makes sense, you can earn a heck of a lot more. So MFA makes mortgages, and these mortgages, where they get the money to loan from this common stock they once sold and the preferred shares and any bonds they have outstanding. They invest in the mortgages, they get the interest, and then they pass that on to their security holders. So this is a pretty good investment that I'll probably hold, for the rest of my life. By the way, if MFA wants to call these in or redeem them, that's fine, because if you buy these at 1965, if they call them in, they would have to pay you $25 because that's the redemption price. So that you'd make a pretty nice profit, even though you'd lose your $1.87 a year, you'd still make some nice profit on the preferred shares. Okay, so hopefully that's been an introductory education into preferred shares. Do your own research, talk to your financial advisor. I do want to tell you that a lot of financial advisors tend to shy away from preferreds, and this is maybe why he's never mentioned them to you. Why is that? If your financial advisor is operating on a commission basis where he buys and sells securities and each time you pay a commission, they don't really like preferred shares because they probably get maybe 2% commission to sell you a preferred share, which you're going to hold for 5 years and 10 years. They don't want that. They want to sell you stuff that you're going to sell it next year and then buy something else and sell something and buy. So preferred shares to a commission advisor is not very attractive. Similarly, to a fee-based advisor, if they have a lot of, say, preferred shares or bonds in your account that don't get traded and just sit there, you might start saying after 2 or 3 years, well, why am I paying this guy an annual fee for managing my account when he doesn't do anything? So registered investment advisors are often worried that they don't want to put too many things in a portfolio that don't change very often because it'll look like they're not doing anything. Now, if you're a smart investor, you might realize that you want to pay him not to do much because you're paying him to not make mistakes and to hold on to the stuff that's good. More next time on Retirement Crusaders.